While technology is still the hot topic, there are plenty of other market sectors that many retail investors are missing out on right now. I want to share 3 stocks in 3 different sectors today that I think a lot of people in the retail investing community aren't even looking at right now. This time, we're not talking about the big tech firms. Instead, we look at a few relatively quiet sectors. Yes, the technology has been working and has been working for a long time, but we are starting to see money rotate into some other parts of the market. In fact, small cap stocks are outperforming year to date, and we are seeing strength outside of technology. I still think it's early enough to get in on a few of these things before they really take off. These are sectors that people could be talking about in 3 months' time. The biggest mistake an investor can make is to concentrate all their investments in one area. Cliché, but true. But if something like AI is running hot, you can make a lot of money if you time it just right. The problem with a sector getting that hot is that it can crash very hard too. There's an old saying in the market that stocks go up the stairs and down the elevator, and that is often just what happens. When a sector has been leading for a long time and finally turns lower, the decline can be incredibly fast. Many investors are caught because they don't sell fast enough. They talk themselves into waiting for the bounce, but occasionally the bounce does not come anywhere near as fast as they expect, and the prices keep dropping. That's why you need diversification. If one part of your portfolio is down, hopefully something else is up enough to cushion the fall. So with that in mind, let us begin with the first sector, healthcare. One of those industries is healthcare, where people will always spend money. One unfortunate truth about people living longer is that many also develop more illnesses and chronic diseases. That means a constant demand for new treatments, new drugs, and medical innovation. Healthcare spending tends to be resilient during booms and recessions. A recession could cause people to cut back in a multitude of ways, but they're probably not going to stop buying their meds. Furthermore, healthcare is a fertile ground for investment opportunities. On one end, you have big mature drug makers with dividends coming in regularly. On the other hand, you have small, highly speculative biotech companies that have the potential to be giant winners if a drug works. Some of those little biotech stocks double or triple overnight. So healthcare really runs the gamut from conservative income investments to some of the most speculative opportunities out there. The healthcare stock is Ligand Pharmaceuticals, ticker LGND. Ligand has some drugs that it develops itself, but it also acquires promising drug candidates in the early stages. They frequently license them to larger pharmaceutical or biotech companies and collect royalties when those companies develop or acquire those assets. That is an important distinction because it is incredibly expensive and time-consuming to get a drug from the lab to market. The average time to market is 8 to 10 years, and the investment is $2 billion. The stakes are as high as the rewards. The Ligand does things differently. In the early stages of development, when development costs are much lower, they deal in drugs. Then they license those assets to much bigger companies that take on the massive expense, time commitment, and execution risk to finish development and bring the drug to market. Ligand is a royalty company in many ways. Its business model shifts much of the development risk to bigger drug makers. That risk is a major obstacle for biotech companies, which can spend billions of dollars for nearly a decade and end up with nothing if a drug doesn't work. Ligand largely avoids that scenario by monetizing assets at much earlier stages of the process. The model seems to be working. The company has about $780 million in cash on hand and has generated positive cash flow in 9 of the past 10 years, including the past 6 years in a row. It generated a cash flow of some $120 million in the past 12 months. Profits are projected to triple by 2030 and quadruple by 2032. Ligand also has over 100 drugs either on the market or in development. And it's a very, very lean operation as well, with only 40-odd people because it's not pumping giant resources into the late stage of drug development. Instead, it will point interesting opportunities to larger firms willing to take the development risk. The stock's had a big run this year already, but those long-term profit estimates are still quite impressive. The valuation is high, sure, but that's mostly because the growth rate is so high too. Wall Street analysts, for example, are often slow to react. They tend to raise price targets and earnings estimates after a company has already reported good results and the stock has already moved higher. They tend not to want to risk their necks. It's much easier to follow the crow than to make a bold call early. So I'm very comfortable being on the opposite side of analyst sentiment. An interesting tidbit also is that Ligand's float is currently shorted by about 9%. That's not an extreme level, but it's getting close to where I notice it. The stock is now up, leaving every short seller sitting on a bigger loss. At some point, they must decide how much pain they can take before closing their position. To close a short position, you buy shares. Buying increases demand. Ligand is at an all-time high right now, so every short seller is underwater. No one knows how much higher they'll go, 5 points, 10 points, or a lot more. But every move higher puts more pressure on those positions, and that creates the possibility of a short squeeze that can push the stock even further. The second one is insurance. Insurance is not nearly as sexy as technology or biotech, but we are beginning to see some very good performance in insurance stocks. If you look at the insurance ETF, it's been showing some pretty good strength, and a lot of the individual companies have been moving higher too. Interest rates are still way higher than 1 year ago, and I expect them to go higher still. Inflation is still far from under control. Since the war, gas prices have dropped, but consumer prices have not generally. Furthermore, we have a very strong dollar, which I think is another indication that markets are pricing in higher interest rates. Higher interest rates are usually good for insurance companies because of the nature of their business. They take premiums and invest the money in very conservative assets, mostly bonds. Bond yields are higher, so insurers are earning more on those investments. If you file a claim, you don't get a larger payout just because interest rates have increased. In short, the company gets a better return on its investment portfolio, and that increases its profit margins. If rates keep rising, insurance should be a good sector to own. The insurance company Aflac, ticker symbol AFL. The first point is that it yields a dividend of around 2%. That's not a whole lot, but it's significant. More importantly, the company has increased that dividend every year for 33 consecutive years. A record like this speaks to disciplined management and a strong commitment to shareholders. Buy the stock now and hold it long term, and your income is likely to keep rising. There are also some parts of the business that are especially attractive. The global pet insurance market is forecast to grow at double the rate between 2025 and 2030 and expand to a market size of around $17.5 billion. Even if you don't have pets, we've all seen how expensive veterinary care has gotten. The number of pet owners buying insurance is rising, since a single visit can easily cost hundreds or even thousands of dollars. Aflac also has a big business in Japan, which continues to grow strongly. The company also has a much lower debt-to-equity ratio than many of its peers. This is a good indicator of healthy financial management and a healthy balance sheet. Less debt also gives management the flexibility to finance acquisitions or expand into new markets if they choose to do so. Wall Street analysts don't seem too excited about the company. Just 3 of the 14 analysts who track the stock recommend it as a buy. That will leave me room for future upgrades. Analyst opinions are often overly optimistic, but upgrades can move stocks higher. A big analyst upgrade at the right time can be a big catalyst. There is not a lot of room for a broad-based downgrade, given the current sentiment. We do not see the earnings exploding like they do at Ligand, but we see them growing about 20% from 2026 to 2029. So it is still a growth story. You're in a company with a good interest rate environment. Insurance markets are good, there's a rising dividend, and there's not a lot of Wall Street enthusiasm. Overall, I think it is a very attractive arrangement. If you own a stock such as Nvidia or even Ligand and it performs exceptionally well, that is certainly advantageous. Those types of investments can really help your portfolio. But most of the wealth comes from companies that grind higher slowly year after year. Sometimes the market will fall. The way most people get rich is by owning good businesses for the long term that increase in value over time. Slow and steady may not be exciting gains, but it gives investors fewer reasons to panic. When these kinds of stocks pull back, the declines are usually not nearly as dramatic. They tend not to fall off a cliff, and that is easier to hold psychologically. When a stock falls 10% in a week or two, many investors panic and sell. Still, quality firms tend to recover from such dips. It may take weeks or months, but many eventually go on to make new highs. The way to make money in the market is to stay in for long periods of time. Another phrase is that time in the market beats timing the market. The longer you can remain with a quality company, the better your chances of success. That's easier to do with a company like Aflac, which has a steady business model that gives investors confidence to weather market fluctuations. Now we move to the third sector, banking, and in particular, the regional banks. I like the banking sector, but I think that regional banks have opportunities to find companies that many investors don't know about. JP Morgan Chase, Citibank, Bank of America, and Wells Fargo are household names, but regional banks can be less visible. Banks, like insurance companies, tend to do better when interest rates are higher because they earn more money from interest. Of course, there is a balance. Very high rates may discourage demand for loans and increase banks' cost of deposits, but I think we're getting close to the right level. The banks can keep cranking up their interest income. Interest rates can probably tick up a little more without really hurting the economy. Most of the big banks have already done very well. Shares of Citigroup, JP Morgan, Bank of America, and Wells Fargo have all done well. I think the regionals have an opportunity to play catch-up now. One regional bank I like is Atlantic Union Bankshares, AUB. It's a regional bank in the Mid-Atlantic region. If you don't live in Virginia, Maryland, North Carolina, or Washington, you probably have never heard of it. The company currently pays a dividend yield of about 3.5% and has increased that dividend for 15 consecutive years. It has been operating for 124 years. What I find really amazing is that in its long history of 124 years, the company has had only 5 CEOs. Current CEO John Asbury has led the company since 2016. That kind of consistency reflects the culture and long-term management philosophy of the company. It reminds me of the Bailey Brothers building and loan in It's a Wonderful Life, a business that's been around forever, run consistently, and focused on stability. Deposits at Atlantic Union cost about 1.9%, or about 20 basis points below the national average. That's probably not great for a depositor, as you're earning a little less interest. But that's good from an investor's perspective, as it keeps the bank's funding costs lower. The company's return on assets, return on equity, and profit margins are all rising. What's even more encouraging is the quality of its loan book. The percentage of non-performing loans has dropped to a mere 0.36% of total loans from the previous quarter. Net charge-offs are basically non-existent at 0.02%. Net charge-offs are loans the bank has essentially given up on collecting. At that point, a loan is a total loss and is written down. A 0.02% charge-off ratio is an extremely low figure. Management also expects tangible book value, a key measure of valuing banks, to grow about 12% to 15% this year. That's significant growth for what many would consider a pretty sleepy regional bank. The dividend is still a key part of the investment story. 3.5% is pretty much the very bottom of what I consider personally to be my sweet spot for dividend investing. I generally like to see a yield of 3.5% or better. More importantly, the dividend keeps going up. The company just boosted its dividend nearly 10%, and these have been solid bumps over the years. Some companies maintain a dividend growth streak by raising the payout by a fraction of a percent each year. Atlantic Union has suggested much larger increases. You get a yield of 3.5% today, but if you keep that stock for 5 or 10 years, you may end up with a yield of 7% or even 10% on your original investment. In a perfect world, you would be making about 10% per year on your initial investment after 10 years. And if you are also reinvesting those dividends along the way, the power of compounding really starts to accelerate. There are 3 sectors that I think need a lot more attention than they are currently getting: healthcare, insurance, and regional banking. While much of the market is focused on technology, these areas provide compelling businesses with solid fundamentals, attractive long-term growth prospects, and opportunities that many retail investors today may miss out on. Thanks for watching. Please subscribe to the channel.